So you found it, the perfect car, but you're not about to pay cash for the whole thing. All of a sudden, you're standing in a fork in the road. Do you lease it or do you finance it? This is a huge decision, and it's got some serious long-term financial consequences. Okay, let's dive right in and figure out which path is the right one for you.
This has to be one of the most common questions in all of personal finance. Is one option just flat out better than the other? Well, the answer is it totally depends on you, your lifestyle, how much you drive, what your financial goals are. They all play a massive role. To really get it, we're going to follow the story of two very different drivers.
All right, let's meet Anna and Marco. So Anna, she's our trendsetter. She loves having the latest tech, the newest style. She doesn't drive a ton of miles, and honestly, she'd rather have a lower, more predictable monthly payment. Then you've got Marco. He's a total road warrior. He's driving long distances for his job. He wants the freedom of actually owning his car, and he plans on keeping it for years and years. Their needs are so different, which makes them the perfect examples for these two paths.
First up, let's follow Anna. She's really drawn to the idea of a shiny new car every couple of years, without that big long-term commitment. So naturally, she's looking into the world of leasing. Let's break down what that actually means. The easiest way to think about a lease is that it's basically a long-term rental. That's it. You're not buying the car, you're just paying for the right to use it during its prime, usually those first 2 or 3 years. Your payment is really just covering how much value the car is expected to lose while you're driving it.
Okay, let's talk about maybe the single most important term in any lease, residual value. This is the absolute key to understanding your payment. It's simply what the dealership predicts the car will be worth when your lease is up. And get this, a higher residual value is actually great for you because it means you're paying for less depreciation, and that means a lower monthly payment. Next up, you're going to run into this weird term called the money factor. It sounds super complicated, but don't let it intimidate you. It's just the interest rate in a clever disguise. Dealerships show it as this tiny little decimal, which can be really confusing if you don't know the trick to translate it. So here it is, the secret decoder ring. You take that money factor, which might look like, say, 0.0020, and you just multiply it by 2,400. That's it. In this case, boom, you get an APR of 4.8%. This is so crucial for you to understand how much you're actually paying in interest and to really compare different offers fairly. So you can see right here why leasing is absolutely perfect for Anna. She gets those lower monthly payments and a brand new vehicle every few years. She isn't worried about building equity because what's important to her is driving a new car that's always covered by a warranty. Things like mileage limits and never truly owning it, for her, those are just trade-offs she's happy to make. Now, let's switch gears and talk about Marco. His priorities? Completely different. He sees a car as a long-term investment, and he craves the freedom that comes with actually owning it. For him, financing is really the only way to go.
When you finance a car, you're taking out a loan to buy it. Simple as that. The car is yours from day one, even though, the bank technically holds the title until you've paid off that loan. The really important part here is that every single monthly payment you make is going towards owning an actual assets.
And that brings us to the biggest benefit for someone like Marco, building equity. Equity is just the difference between what your car is worth and what you still owe on it. As you pay down that loan, your equity grows. And once the loan's all paid off, you've got this valuable asset and, best of all, no more monthly payments. For Marco, that's what financial freedom looks like. Now, it doesn't matter if you're leasing or financing, your credit score is hugely important. But with financing, it directly affects the interest rate you'll get on your loan. A higher score could literally save you thousands of dollars over the life of that loan. A lower score, well, that's going to make borrowing a lot more expensive. This really lays out Marco's decision perfectly. He's totally fine with a slightly higher monthly payment because he knows it's letting him build equity. He has 0 mileage restrictions, which is absolutely essential for his job, and he has the freedom to customize his car, or even sell it, whenever he wants. Yeah, the car will lose value, sure, but that long-term payment-free ownership, that's the end goal for him.
Okay, so we've seen the two main paths, but before you go picking one, any good financial advisor would sit you down and tell you to look very, very closely at the fine print, the hidden costs and potential traps that can pop up with both options. This is where you really need to pay attention.
If you're leaning towards leasing like Anna, this number should make you sit up straight. Most leases have a really strict mileage limit, often somewhere around 12,000 miles a year. If you go over that, you're going to pay a penalty for every single extra mile. And trust me, it can add up incredibly fast. Driving just 10,000 extra miles over 3 years could slap you with a $3,000 bill when you go to turn the car in. Ouch. And here's another one of those sneaky costs with leasing. Because the leasing company still owns the car, they want to protect their investment. And that means they often require you to carry way more insurance coverage than your state's minimum. What does that mean for you? Well, your monthly insurance bill will probably be higher than if you financed the exact same car. Now, let's talk about a super important piece of protection for both Anna and Marco, gap insurance. If your car gets stolen or, heaven forbid, totaled in an accident, your regular insurance only pays you what the car is worth at that moment, its cash value. But you might owe a lot more than that on your loan or lease. Gap insurance covers that difference, that gap, and it can protect you from a massive, massive bill. Honestly, it's a must-have.
All right, we've talked theory, we've looked at the concepts. Now let's get down to the hard numbers. We're going to compare the total costs for Anna and Marco over a 5-year period to see how their choices really stack up when the rubber meets the road.
Okay, let's break these numbers down. Anna's average monthly lease payment is a little bit lower, around $659. After 5 years, which for her would mean one 3-year lease and then starting a new one, she spent close to $40,000, and she owns nothing. Marco's payment is a bit higher at $682. He spent a little more overall, but at the end of those 5 years, he owns his car, free and clear. He has an asset, and he has no more car payments. So we followed Anna, we followed Marco, and we've crunched the numbers. Now for the most important part of all of this, turning the question back to you. Which one of these paths actually fits your life? To figure this out, just ask yourself these simple questions and be really honest with yourself about your driving habits. Think about whether owning an asset is actually important to you. Decide if you care more about having the newest tech or if you're focused on long-term value. Your answers are going to point you pretty clearly in one direction or the other. At the end of the day, there is no single right answer here. There's only the right answer for you. So, are you an Anna, valuing flexibility and always having the latest features? Or are you a Marco, focused on that long-term ownership and the freedom that comes with it? Now you know the difference. The choice is yours.